Hi, Kevin Gormley again, CPA that does financial planning, here today to talk about municipal bonds for high-income investors. As I said before, it's not really a tax on the rich as much as it is a tax on people that have high income. And I think muni bonds can be a great diversifier for taxable accounts. They're not for everybody, but they're not just for retirement anymore. They used to be thought as something that can give you tax-free income in retirement, and I think they're just a great diversifier. So let me make my case for and then against using muni bonds and see what you think. So if you make more than $200,000 and you're single, or if you make more than $250,000 married filing jointly, MFJ, you're in the 33% federal tax bracket. And what we need to do with muni bonds is compare them to a taxable, fully taxable equivalent corporate bond, even though, again, the risk parameters are not exact. But with a corporate bond, you would pay 33% tax on that corporate bond. We'd also, in the state of Tennessee, would have to add a income tax, which is called the Hall tax. We don't have an earned income tax in Tennessee, but we have an unearned income tax on investments. So not as friendly in Tennessee with investments. Many other states have income tax on investments as well, but some states are truly tax-free. And now we have the new 3.8% Medicare surtax. Mr. Obama wants us to call it a net investment income tax, however, because he doesn't want it associated with Medicare. But it's the Medicare surtax that you've heard about. So when we add all these numbers up together, we get 42.8%. So 42.8% of every dollar that you earn is sent to some different government right now. You do pay your taxes on the money you earn, and for your investments you choose on how much taxes you want to pay and how much you want to keep. So again, with muni bonds, if you make more than 200 or 250 and you're in that 42.8% tax bracket, you may want to consider this. What if you make more than 400,000 or 450 married filing jointly? Well, then your actual tax rate is 39.6 plus 6 plus 3.8. It's actually 49.4%, or almost 50. I mean, again, I know some accounting, but 49.4, it's pretty close to 50. We'd still round down to 49, but half of your money in a taxable account, and I'm not talking about U.S. stocks. U.S. stocks don't have this full taxation. Much more preferable tax on U.S. stocks, and that's the reason why we try to put those in taxable accounts. So let's say, for example, in Tennessee, the Knoxville County comes out with a Tennessee municipal bond in Knoxville for 4%. Okay, and we'll go with the 49.4% tax bracket. So about half of my money is taxed, and so a 4% bond would be about a 7.9% tax equivalent, a tax equivalent bond of about 7.9%. So I would ask you not to think about this versus equities, but it's the risk parameter of muni bonds, and we'll talk a little bit about the negatives of individual bonds, but it's somewhere between keeping your money in the bank and investing in very highly speculative investments. It's somewhere in there. It's probably safer than certain things, but the risks, let's talk about them. There's a chance, and there's been some highly publicized Detroit, as well as others, counties that have gone bust, and they could not pay back their shareholders. But when you look at versus corporate bonds, muni bonds have actually done extremely well at paying back all the money, but there's still a risk. So the other issue with bonds, and I think a lot of investors are not aware of this, they've heard it probably, but they're not aware of exactly how this happens. As interest rates go up, bond prices go down. So if you own a bond fund, the price of your bond fund will go down. Another example would be if a bond is $100, interest rates go up, all of a sudden on your statement your bond says it's worth $98. You still get the same coupon every 6 months. You still get paid your whatever percent that you're promised. It's just that on the balance sheet, on your statements, it looks like that you lost money. So what do? Well, we can buy individual muni bonds. Okay, if we buy individual muni bonds, we can somewhat make a ladder, or at least we can know what is our yield to maturity. And the yield to maturity is probably the most important thing with muni bonds. The yield to maturity tells you what is the amount, what's the minimum amount that I'm going to make on this bond, as long as nothing happens to the issuer in a given time period. And a lot of bonds right now, we can get 3 to 4% in the state of Tennessee. And I think as interest rates go up, they'll become more, even more beneficial. And as you do your taxes next year, when you get your tax bill, if you're a high income earner, I'd ask you to at least think about using investments in your taxable account, maybe just 5 to 10% of your money. Look for some investments that might be a little bit more tax friendly. So thank you very much for watching. Again, my name's Kevin Gormley. Appreciate your time.